Bom dia a todos. Só uma rápida instrução aqui, eu vou passar a palavra para o Guilherme fazer a abertura. A gente está hoje com um canal de tradução simultânea, então você tem aqui do lado, nas instruções embaixo, na parte aqui do Zoom, você tem a parte de record, Q&A, né, e tem uma bolinha de interpretation, interpretação, né, de tradução, é um globinho. Então, se vocês clicarem e selecionarem o canal que vocês desejam escutar, então, vai ter inglês, que a gente vai conduzir o painel em inglês, e a tradução simultânea em português, tá? Então, fiquem à vontade para selecionar aqui qualquer um dos dois canais que vocês preferirem, pode ir trocando no meio do caminho, mas o objetivo aqui é que vocês fiquem mais confortáveis possível, tá? E também fiquem à vontade para fazer as perguntas em inglês ou português. A gente vai coordenando aqui durante a palestra e traduzindo se necessário, tá bom? Vou passar a palavra para o Guilherme para fazer as aberturas já em inglês. Obrigada a todos pela presença.
Ok, obrigado, Tata. Obrigado. Hi, Andrew. Hi, Leo. It was just few words in Portuguese from Stephanie, so you guys probably didn't get what was happening, but just few instructions regarding translation, so no worries about it. So, first of all, thank you very much. I really would like to thank you, everyone, that spared your time to attend this session. And I also would like to thank you, our panelists, Leandro and Andrew, so thank you very much again. From XP, as Stephanie mentioned, she's our head of solutions for XP, and myself I'm responsible for the distribution channel for pension funds. And let me make a brief introduction about them so you can catch up with them. Here we have Leandro Festino. He's a senior consultant at Meketa, and it's quite interesting because he's an active leader in several client boards and committees meetings from pension funds. So I'm pretty sure he will be able to share a lot of sensible information with us. And for those who doesn't know Meketa is a very relevant investment consultant in the market with over that $1.5 trillion under advisor. So it's a pretty relevant global consultant firm. Andrew, he's the CIO for the state of Rhode Island, and previously he was the president of Wilshire Consultant, also working with a number of institutional clients over the world. So I'm pretty sure that both of you guys will be able to share very relevant information, important with everyone here which is attending the session. So I hope that everyone enjoyed this session. Just before we start, I mean, let me give you guys a brief background about the session, because the idea of having such senior guys here in this panel, it's kind of to bring some experience from specialists that have been navigating and investing in a zero interest rates market since the global financial crisis. So it has been over than 10 years that those guys have been investing in a zero interest rates market. So they have been going through similar challenges that we are facing now, especially for pension funds and some of our institutional clients. And it's the same challenge that we probably are going to face over the next years. So bringing them to this panel, I think it would be very productive, helping us and giving support in this challenging scenario from now on. So Leo, if you don't mind, I can start with you and then I hand over to you. Feel free to introduce yourself into more details, and then we go through other topics that we are going to bring for the session. So thank you very much, guys.
Obrigado, bom dia, mas vou falar em inglês. Good morning, everyone. I'm pleased to be on this panel. I thank Guilherme for the invitation. As he mentioned, I'm a consultant working with about a dozen or so large institutional retirement plans or other kind of endowments, primarily in the US. Our clients today, and essentially all institutional investors, have exposure to essentially all asset classes. So we consult on all asset classes, from bonds and equities to all kind of alternative assets with a global view. We have offices, multiple offices in North America and in Europe. And in Brazil, we have a partnership with PPS as well. Over 200 employees. And I've been with the firm since 2003, so I can share first-hand experience about how things have evolved over the past close to 20 years, and then I have anecdotal information from my firm about what happened, in the 25 years prior, as the firm has been around since 1978. Interestingly, our first client from 1978 still a client today. So I can go back and look at different times and look how those funds, those assets were invested. For example, January 1, 1990, that fund was invested 57% in stocks and 43% in bonds, all US exposure. If you go back, that same fund would have been invested in the 70s, 80% or so in short to intermediate treasuries, and about 20% in large blue chip stocks in the US. Think of Exxon, IBM, etc. If you go back to 1990, T-bills were yielding about 7.5%, coming down from about 15% in the decade prior. So a very different environment, and we've been on a declining interest rate environment, which has pushed investors to take more and more risk and lowering their exposure to bonds, essentially. So today, there's a lot of different databases, and you can see how a typical fund is invested. Public funds, make their information widely available, so it's a good starting point. Today, the average pension fund in America, in the States, has about 20% exposure to bonds, a combination of investment-grade bonds, T-bills, cash on average, and about 5% or so in high-yield bank loans, rather below investment-grade categories. The rest is invested in equities or alternatives. So roughly 25% in the stocks in the US, another 20 to 25% in the stocks outside of the US, and the balance about 30% in alternatives, which includes hedge funds, private equity, private debt, real estate, natural resources, infrastructure, etc. So over a period of about 40 years, it went from 80-20 in bonds to the opposite, 80-20 in the stocks. And I've seen some that are as close to 90-10. And so that tells you how much it's changed as a result of, a lot of exogenous factors. When I started working at Meketa in 2003, typically, every new client that came to the firm had a very, at the time, plain vanilla portfolio of what was known as a 60-40 portfolio, essentially 60% in stocks, primarily in the US and in other developed markets, and 40% in high-quality bonds. Our typical client at the time had a more diversified portfolio. He had exposure to emerging markets, to high yield, and to private markets and alternatives. And so it was easy at the time to make improvements by essentially diversifying the portfolio into other areas, and you could lower risk and improve the returns quite easily. I think every client we picked up in the last couple of years already has done that. So I think the difference is in slight tilts, but primarily in execution. As you go into the alternatives, especially into the private assets, the average return means little because there's a huge dispersion of returns. So I think the game changes from a beta to an alpha game, and execution is definitely critical. Some more data points about what's happening in the US. Public pension funds had targets to make about an 8% to meet their liabilities in a given year. And that over the last decade has come down dramatically. Today, it is about 7.2% is what a pension fund needs to make on average to meet their liabilities. And it's coming down. I would be shocked if in the next 3 years it's not at 7% or below. Obviously, that's because interest rates have been falling. When you model these returns into the future to try to meet your liabilities, I think the real rates have not changed much. I think on average, a pension fund has about 4 to maybe 4.5% in real returns in a typical mix of assets. The inflation assumption has come down as well. So that's what really brings the nominal rate from 8 or above 8 to just about 7 these days. A little bit about interest rates, and then I'll jump into my thought about the Brazilian market. And I think after that, I will pause. I will let Andrew make some statements as well, and then I'll be pleased to answer any questions about any clients or any specifics that anybody in the audience may have. So my understanding is in Brazil, the 10-year yield last I looked was about a 6.5% yield. I think the central bank rate was just about a 2.25%. So given where liabilities are, I think what's going to have to happen is something similar to what's happening in the US. And that means pension funds will have to move into riskier assets. And that means any kind of equities, whether it is private equity or listed equities. I know there is very limited exposure overseas, so that's a simple way, assuming regulation allows it, and the policy statement allows it, which can be modified. It's an easy way to generate at least the expectation of higher returns while you also continue to diversify the fund. So I think this will happen again for the following reasons. Number one, central banks all over the world have tried to minimize the effects of bad economic decisions, of bad dealing with the COVID, the coronavirus, of excessive bank lending. And they've done this by keeping interest rates low and making money cheap or free. To an extent, this has worked. People have become addicted to what is known as the Fed put. No matter what happens, the Fed will always bail you out by printing more money. So in a sense, bad news becomes good news. And maybe that is why even through this pandemic, we have markets at close to new highs despite a very dire economic situation. Today, the world has about $300 trillion in debt. And that is a debt that is known, that is calculated. There may be more out there from China and other places we don't really know. On the other hand, global GDP is at about $100 trillion. So we have about 2 to 3 times at least as much debt as we have GDP to grow our way out of it. The central bank's theory is if we don't keep money cheap, global GDP will decline. We may have recession or depression that will make the situation worse. So we have to prop up global GDP by pumping money into the system for free. So the question is how long this will go. I don't know the answer, but I suspect probably a lot longer than most people believe, maybe at least another 10 years or more. I think what the Fed and other central banks do is not so much as give people free money, but they give confidence. No matter what happens, we're going to bail you out. And when you're not afraid, you tend to do business, you tend to invest, you tend to take risks. People get terrified, otherwise they pull money back and then you go into recession. So I think the central bank printing money and keeping interest rates low or very low is likely to succeed and is likely to be with us for a good period of time. So I think for that reason, investing in bonds is not gonna help a lot. I think you could, even though you might think it's risky to go longer in duration, I think it still makes sense because rates can still come down. So I think that may be an arbitrage. And I think the rest of the portfolio should go into some kind of equities. And then I guess we can debate which kind would be better. Recall again that it wasn't that long ago when people were saying we cannot have negative interest rates, but we cannot have this amount of debt, the system will collapse. It hasn't. So we'll see how much more it can sustain. I suspect there's still a lot more that can be done. And I don't think we're going to see an increase in interest rates for quite some time. We'll have to have tremendous inflationary pressures, and we can debate what could cause that. But again, that's not something that we see forthcoming. My last point relates to bonds. I think all pension funds and investors typically have to own some kind of bond. I think the amount of debt out there in the marketplace has become quite large. And I think when you buy a bond, you tend to assume, okay, that's an asset, I put it on my account. But the reality is that there's difference between good assets and bad assets. Some bonds may not be repaid. As an example, we have about $1.5 trillion debt in college from millennials that went to school, what do you think are the odds of a 25-year-old kid to pay back that debt? I think, it may not be that high. And so again, it's going to be very important to discern which kind of credits or debt or bonds will be appropriate to have in your portfolio, since you're going to have a smaller pool into fixed income. So to wrap up my comments, I think the important thing is to try to figure out where we're heading as an economy, as a world, as a nation, and then try to pinpoint the better areas in which to allocate assets. I think, just to provide some indications, I think in the the West, an outcome is that potentially mega companies are going to do well. The Amazons, the Walmarts, the Microsoft, Apple, Google may crush the competition. I think we've seen this happening. There's been long thesis, small caps will outperform. We're not seeing that. It could be the case that changes. On the other hand, other industries like leisure and travel may not do well. So whether it's via private equity or public equities, I think active management will have an important role to play. I will pause there, and I think I went about 15 minutes. That's about as much time as I wanted to spend with some initial remarks. And we'll pause and invite Andrew to provide some introductory views from his perspective as the CIO of the state of Rhode Island. Thank you.
Well, great. Thank you very much, Leandro, and thank you all for having me. I'm pleased to be here. This is, I want to start by saying I've been a consultant for 25 years. I've been a CIO for 3 weeks. So that should probably inform your thinking about my comments. But being in the industry for as long as I have, I've seen lots of changes. I've seen the evolution of the US market because I've predominantly worked with US-based clients, and seen how people have reacted to this long, slow, gradual decline in interest rates, and understand that that is an issue that you're facing in the primary point of this topic. So what I wanted to do is kind of use a little bit of my history as a guidepost to make some comments about how the way US investors have changed and how it might be informative to Brazilian pension funds in dealing with lower interest rates. So when I first started, so my first year in the industry was in 1994. Interest rates went up in 1994. And so I just assumed that interest rates could periodically go up. Little did I know that that really wouldn't happen again for the next 25 years. But everything used to be very traditional. As Leandro said, it was very much stocks and bonds, blue chip. People would get a little bit adventurous and allocate some money to small cap companies. But that was kind of it. It was pretty straightforward, kind of 60-40 stocks, bonds, portfolios. In the US, we still kind of use 60-40 as a shorthand to a very traditional portfolio. Over time, alternative investments, private equity, hedge funds, real estate began to be included in portfolios, but it was a very slow process to educate boards about the risks and the characteristics of those, to include them in portfolios. And it tended to be very small allocations, sort of, let's try this out and see how it does. So a 5% allocation to real estate would have been, I think, pretty big in the late 90s. The asset allocation process in the late 90s was very, very quantitative. It was very much what we now refer to as mean variance optimization. You just put some numbers into the engine, right? Risk, return, and correlations, and it gave you an answer. And everybody believed that answer. There was a lot of implied precision to that we now recognize doesn't really exist, because that process is so sensitive to assumed returns, and nobody knows what returns are going to be. Just as another example of maybe why you should discount some of my thinking, in the U.S. there was a pension law change on the corporate pension side in 2006 that really kind of forced corporate pensions to begin to really consider long bonds much more significantly as a part of their allocation. And I instructed a number of clients that maybe we should wait until interest rates were a little bit higher. And so I've been waiting for higher rates for about 14 years on that. So it's a little, I'm just saying, learn from my mistakes. There's plenty there to go off of. Risk management, I think, was not even something that people talked about or considered in the late 90s. And really, even after 2001 and 2002, when we had a significant pullback in the equity markets, there wasn't a lot of talk about risk management on the other side. So moving into the 2000s, though, allocations to these alternatives continued to grow. I put that in quotes because I think at this point in the world, they're not alternatives anymore. The typical pension plan in the U.S., as Leandro pointed out, really there's not much exposure to bonds. I look at our portfolio at the state of Rhode Island. We've got 20% in bonds. I would say probably 15% of it is investment grade, and the rest is serving some other purpose. But private equity is no longer an alternative. It is a key component of everybody's portfolio. I would say the same thing about real estate. So that's an evolution. 2008 was certainly a watershed moment for investors around the globe. And I think it was, in the US, a wake-up call to people that markets don't just always go up, and that risk management needed to be part of the investment process more than just sort of an input to an asset allocation model. And the middle of a global financial crisis is not the right time to realize you've misassessed your tolerance for risk. But a lot of people found that out the hard way. There's another sort of nuance that happened kind of around the same time. And in the US, most pension funds went from cash flow positive, where contributions exceeded distributions, to being cash flow negative, which is the reverse. And that forces you to have to be a net seller of assets throughout. And in cases like 2008 or what we saw during March, you don't want to be selling assets at the bottom of the market. You don't want to be a forced seller for non-economic reasons. And so people had to rethink liquidity. And I think that what actually happened on the asset allocation front is people began to move away from some of the precision that was implied in the models that we used in the 1990s, and begin to think about what is the strategic purpose of this allocation. So at the state of Rhode Island, we talk about a number of different buckets in our portfolio. One is growth, so that's public equity, private equity. One is income. That is not where all of our bonds go, but that's where some of them go. One is volatility protection. That's where actually our long treasuries go. So we've found a place, even with the US 30-year treasury at 1.3, 1.4%, where it still makes sense for us to own some of that, because in cases where equity markets decline sharply, there's a flight to quality, people panic, and we suddenly have something that's liquid and rising in prices, or historically has been. So I think we've seen this sort of back to basics approach. I think we've seen with the investment committees that I worked with as a consultant and in my 3 weeks as a CIO, a willingness to understand that that we are making decisions under uncertainty. We can all have a view on markets, and we should. We can all have a view on interest rates, and mine has almost always been wrong. But we need to recognize that the expected case is not the only possible state of the world going forward, and prepare for things that we don't think are likely, but still may come to pass and have a meaningful effect on our portfolios. So the last bucket that we have in our asset allocation is inflation. I agree with Leandro. I don't think we are in a world where there's going to be meaningful inflation for the next 5 or 10 years. I think there's been too much destruction in demand thanks to the virus. But it's important for us to continue to have that allocation because we may be wrong. And a lot of the investment decisions that we make is about where can we be wrong and how can we protect ourselves from being wrong, because we know we will be. So I think, and this will sound very, very basic, and I don't mean it to be so basic as to be insulting, but for us, the first and foremost thing we think about is overall portfolio diversification, right? And it's we think that the strategic asset allocation that we set and leave alone for 3 to 5 years helps us achieve our long-term goals and won't get us in too much trouble if things come off the rails. So I think I would just end with saying, in a low rate environment, to sort of summarize, I think it's critical to understand the role of every asset class that you have in your portfolio and protect against things that you don't think are likely but may come to pass. So I'll turn it back over to you, Guilherme.
Okay, thank you very much, Andrew and Leandro, for both explanations. I mean, great experience and sensible information with the segment, so thank you very much. I have a few questions here, but I would like to make a comment about Andrew, some of the topics that he mentioned, especially because when he mentioned that private equity and in real estate, it's not an alternative anymore, it's key in your portfolio. And I mean, it's very interesting because looking through our segment, it's a 1 trillion reais AUM, which means $200 billion under management with this segment. And it's completely the opposite. It's 80% bonds and 20% in risk assets, and you are 80% in risk assets and 20% in bonds. So I would say that it's scary, for myself and for the segment, because they have been investing in bonds to match their liabilities until 3 years ago, and then we are facing almost zero interest rates. In nominal terms, it's 2%. It used to be 15% 3 years ago, and now the real rates, I mean, for a 10-year bond, it's kind of 2 to something. So it's scary, being very honest. So bringing this knowledge and bringing this experience, it's key for us. So thank you for sharing this information. I think there is some key points that we need to take, that our market is not that mature, so we need to work in both sides. It's kind of find more, I mean, the demand will be here for investments, but the offer needs to be there as well. So the market needs to grow as well to help the pension funds to allocate this capital, but it's going to be gradual. They will start with liquid assets, going through more equities, public equities, going through more hedge funds, and then moving in parallel to real estate, to private equity investments, which makes sense. It's not me telling that, it's you guys, I mean, that have been working 10 years or more in zero interest rates. So it's something that it's impossible to avoid. It's a matter of time, it's not a matter of if it's going to happen. So great topics that you point out, Andrew. Stephanie, would you like to make some questions? So, but I have mine. It's up to you.
Sure. No, I have several. We can ask like 100 questions, to be honest, because as you guys mentioned, both Leandro and Andrew, painted a picture of us, 10 years ago. It's you, and our industry here in Brazil is going through exactly the process that you went through, throughout the past 10 years. And it's been very challenging because us as investment professionals, we've been trying to foment and bring more information and more experience, because it is a difficult process to switch the portfolios and to have that movement brought not only to the boards, to everybody that was used to having their own personal investments, giving 15% a year without having any risk or volatility to the portfolios. Imagine going to structured credit or real estate, or even more alternative assets such as venture capital, which I know for a fact that has been inserted in the pension funds and large institutions' portfolios for a few years now. When you think of that reality for Brazilian pension funds, it's such a switch, such a swift from one to the other. So I actually wanted to ask exactly the point, and I'll direct this question to Andrew, but Leandro, please, I think you can add to this as well. But thinking about the alternative product, as you mentioned that it's not even alternative assets anymore. How fundamental have you seen this become in the portfolios in terms of behavior of the portfolios throughout the years, as you increase the exposure to the alternative assets, as we call still in Brazil? And then a second question to add to this would be, what have you guys have been considering as the actual alternative assets nowadays, since private equity and real estate have been structural parts of the portfolio, as we believe it should be? What have you been seeing as that additional spice to it? So I'll give you those two questions.
I think that's a great question, and actually something I meant to mention. The average institutional portfolio in the U.S. has a 25% allocation to what 10 years ago we would have called alternative assets, and that's really primarily private equity, private real estate and infrastructure, and hedge funds. 10 years ago, I think that number was at about 15%. I think when you look forward 10 years, it's not going to be 25, it's going to be probably 30, 35. I was on a call last week with a number of US investors and consultants and managers, and there was some polling done in the moment, live polling, and one of the questions was, as a result of things that happened in March, are you going to be increasing, decreasing, or staying the same in your private allocations? And half of the people there said they were going to be increasing it. If you think about, and I don't have the numbers right in front of me, but I think there is $1.5 trillion that has been committed to private assets but not yet invested. So dry powder that's just waiting for opportunities. And so what's happened, as this is, I guess it's good news that it's been broadly adopted institutionally, but there's bad news too, in that we've arbitraged away a lot of those excess returns. So in the late 80s and the early 90s, private equity should have been making 25% a year. It was a very small part of the business. It was, there wasn't a lot of capital chasing deals. Right now, when we look at private equity, we're hoping that it produces public equity returns plus 2 or 3%. And that number used to be plus 5 or 10%. So I think as people continue to deploy capital there, it's going to continue to chip away at some of those excess returns. But I think that it will continue to grow. To get to your second question, what do we now consider alternatives? Boy, there's almost nothing new under the sun that we haven't thought about as a community. I mean, there are some people that will make investments in collectibles, art. I've seen some institutional investors make those investments, or investments in gold coins, which is just hard to imagine. Music royalties is another one that, you know, somebody bought the catalog of songs that the Beatles had produced, and every time one of those songs get played anywhere, a penny goes to that private equity fund. Well, the Beatles get played a lot, right? So eventually you're collecting a lot of pennies. But I mean, if we as an industry have gotten to that granular a level already, I don't know what else is out there. So that's probably a better question for Leandro.
You did say you'll send the hard questions to me, so I will try my best. So one thing that we've noticed a lot of demand, and it's increasing in a lot of institutional investors' portfolio, has been a variety of private debt strategies. A lot of private credit, loans of all kinds has been a growth area, probably the one with the highest growth over the past 5 or so years. On a much smaller scale, there's been other ways to try to add a return stream that is diversified from the markets. And so I think catastrophe bonds or insurance-like products, things like that, have been wrapped mostly in hedge fund-like portfolios, and also volatility trades, which again may be somewhat different than than the market may move counter to, and it may fit into that protection, risk mitigation, volatility bucket that Andrew mentioned earlier. So buying going long volatility, etc. So those could be other areas, but again, it's a much smaller capacity. So I think the money has been flowing into private debt as a new area. I'll agree with the comments on the first question. I've seen clients go in private equity from 5 to 10 to 15. It takes a few years, always at a minimum, to get there. The numbers are the same that I'm expecting, that I'm familiar. I see most at least maintaining, if not increasing, the allocations there. I think we're moving from a portfolio when we used to have exposure across all asset classes. I think we're moving more to a barbell approach, where you have cash and those treasuries to really protect today, tomorrow, in the near term, and then the rest you go all in, because you have protection for the next year or two with that protection bucket, and then everything else you gotta go and generate returns to get your the numbers you need.
Perfect, thank you.
That's great. I have a question. I think I can address to Leo, because he mentioned the beginning of your explanation, Leo, about how investors have been playing the difference between beta and alpha in their portfolio, and we have a 10-year bull market since the global financial crisis, thanks to the liquidity that the central banks have providing, and some of course the good economic background. Of course, it was not only flow of money, it was economic background and in earnings growth in the companies as well. But we know the liquidity help it to support that movement a lot. What do you think from now on will be the reality between beta and alpha? Because 4 to 5 years ago, it was kind of fasten your seatbelt, buy a cheap beta, and then you will perform. And now, maybe alpha will be, have a major play in clients' portfolio. But what do you think from now on? Regarding coronavirus, we have this drawdown in the market, and now we still have liquidity provided by central banks, and the market recovery very fast. So it's not that obvious that play within beta and alpha. So what do you think?
Yeah, it's a great question. I think you need to separate the market into two areas. One is in markets where you can get beta for essentially cheap or free, like equity markets as an example. And then another one where that passive or index approach may not exist, as in private equity. So if we start with the first one, listed equities, I think no matter what statistics or database you look at, it's difficult for the average active manager to perform and execute. At least it has been the case. There's always some cyclicality to it. So I think that will continue to remain and be the case, just because it's essentially free to get exposure to beta. You know, on average, each manager has to underperform because there's cost involved in those operations. However, as you move away from the blue chip names into more global portfolios or into smaller sections of the market, I think the coverage declines and the math shows that the probability of outperformance by a given manager increases. In other words, there's more dispersion of returns. So you can combine cheap beta with highly focused, high expectation, high octane portfolios for managers to try to generate alpha and come out net better, net of fees on a risk-adjusted basis. As I mentioned earlier, I think we're going into an environment where active management may benefit from it. There's going to be a lot of dispersion of returns within industries and sectors. If you invest all across in the market, you might not get it. I think one needs to be humble enough to recognize that there is a probability of making mistakes here, but if you size those bets appropriately, you might come out ahead and you may be able to add a few percentage points here and there. If you do that over 40% of your portfolio, which is what is listed equities today on average, it can add meaningfully to your bottom line to get to your 7% return that you need today. Second part is where there's no index fund, and there you have no option but to go active, and there is where I think returns are made or lost. Why? Because I've seen pension funds generate consistently 15 to 20% return on average year after year, going back a long time, but also doing that in recent times. And then I've seen some when at best they recoup their money, if they're not losing much. And when things go wrong, it is really bad. You cannot find ways to exit those portfolios. They remain on the books. They begin to take a lot of your time. They're not adding to it. It's almost like a dead weight that doesn't allow you to move fast enough to generate returns, and it takes many years to work out. So whereas if you make a mistake with listed equities, you can fix that quite quickly. It is paramount to get it right in the privates, and that's why I think going slowly is critical, making sure you have access to what you think are the best ideas. I think going into your second or third best idea is a losing proposition, and it's better not to go. So that issue of can we get capacity and how much money is out there waiting, if you don't think you can get that, that is a risk you should be at least conscious that you're taking.
Okay, excellent, Leo. Thank you for the insights. I have another question which is more specific. I think I can address for both you guys, so feel free to get it, this one. But what we have here in Brazil, it's kind of a huge difference between large asset managers and boutiques, So the alpha that those guys have been generating through boutiques asset managers compared to large asset managers are a major difference. So is it that similar in the US market? The boutiques is still delivering high alpha products rather than the larger market, the large asset managers, or it's a mixed picture? How would you say that it's happening in the US market now? Because I know there's a lot of competition between passive and active managers. Here in Brazil, it's not that situation because the passive management here is still a growing market, so it's a minor market share here. So in developed countries, we have this more efficient market, so we are emerging market, so there's a lot of alpha to be generated, but we know that in the US, in developed market, it's a tougher mission. So what do we say if it's happening as well as it is here in Brazil, those alpha generation between boutiques and large asset managers?
Andrew, you want to take it or should I?
I'm happy to take a swing at it. You'll probably have a comment as well, but I think the growth cycle for asset managers is you start small, you generate really amazing returns, you begin to gather assets, you begin to focus more on running the business and less on running the portfolio. That's the trick, right? So I think there's a a critical moment in a firm's history where they need to decide to separate the professional management of the firm and the investment management of the firm. And in some cases that doesn't happen, and those firms still attract assets, but then they just become about asset gathering instead of generating, and it's harder, right? If you're managing $50 billion instead of $5 billion, you leave bigger footprints in the market. It's you can't take the same kind of positions. You have to, you just have to adapt your process to your size, and then suddenly the things that made you successful may not work anymore. So that's my take. I mean, and we see that on public markets and on private markets. There's some exceptions, but eventually size catches up with everybody.
I agree, Andrew. I think it's well tested that there is an inverse relationship between size and performance. As of course, there's always exceptions to each rule, but as a fund's assets go up beyond a certain point, it becomes very difficult to maintain those excess returns that were the reason for that asset gathering that took place. And so I think if you are a boutique firm, as you describe it, you tend to be independent as opposed to be owned by another entity or part of a larger entity, and you can make decisions that sometimes in a larger institution may be more difficult to make. As a result, boutiques have a higher likelihood, I think, of closing products early and trying to manage that a little better. I think an advantage is also boutiques tend to be focused on maybe one or two strategies or a specific area, whereas a big manager firm tends to have every product on every category. It's very difficult to try to be the best at everything. So I think those are some inherent advantages of boutiques. A main disadvantage is that if you're only focused on one or two areas, those tend to be out of favor. You make a few mistakes, you might not last long enough as an entity out there if you face headwinds. And so there's always pros and cons. But overall, I think as a firm, we tend to side with boutiques who we think may have higher probability of success. If you're going to go active, you need to be different, and you need to try to generate returns above and beyond those as the benchmark.
Okay, great. Thank you. Thank you.
May I ask a question now? Actually, it's a client's question that he has directed here to us. I'll just read it for you because he's made a brief introduction, and I think both of you could answer. I think would be interesting regarding tactical allocation. He says that, well, not only in current times of low interest rates and uncertainty, but also in whatever market we're in, there will always be uncertainties towards the portfolios and great chances for us to be wrong, as you both mentioned regarding our base scenarios. Given that a strategical diversified portfolio is something that should prevail, and have tactical bets that concentrate the portfolio in certain risk factors. But doing that is complicated to implement independently of whatever the macro scenario is. So his questions are, with that, what advice have you guys been giving towards the large pension funds in terms of tactical allocation? What have been the usual tactical allocation plays, let's put it that way, regarding geography, regarding asset classes, and in addition to that, has the current scenario impacted the advice you give to pension funds towards the size or the proportion of those tactical bets in the portfolios compared to previous scenarios or not? Who wants to go first? Leo, you're on mute.
Sorry, Andrew, you want to go, or should I find either way?
Why don't you take this one first? I'll follow up. All
right. So it's a very good question. I think it needs to be divided into two. I think from our perspective at Meketa, we realize that tactical decisions can be another avenue to try to generate incremental returns. And again, in a very low rate environment, you need to think of every opportunity. So even trying to negotiate fees, anything you can do to generate a few extra basis points goes a long way to that bottom line. So I think, again, one needs to be humble to realize that one can make mistakes, and in tactical decisions, that's a possibility because you need to be right when you get in and when you get out. However, there are times in the markets when the dislocation is so large that I think the odds become more into your favor. So if you go back to 2008 and you begin to look at and review what at the time was happening, it implied that, for example, there's going to be so many defaults that a lot of companies were going to go out of business. And by a lot, I mean a lot. And so if you don't think the world is going to end, it's probably a good bet to take that. You know what? While some will, many will not. This will turn. And so that was, I think, a fairly reasonable time to sell high quality bonds that had appreciated and buy some of those distressed high yield, emerging market equities and debt, bank loans, etc. that, it seemed to be a good tactical trade. I think in the last few years, one other tactical positioning was related to, okay, we don't know what's going to happen, but we think this market is running its course, is getting ahead of itself. There's going to be a correction. We might not know what's going to trigger it. So maybe let's start to build positions to defend that. And so whether that is long treasury, as Andrew mentioned, or volatility trades, or gold, or some kind of hedge fund that maybe can be a trend following strategy, create a bucket that will be different and try to generate diverse and differentiated return streams that may go up when everything else is going down. So the timing of implementing and which one of those, can be seen as a tactical approach. The second part of this, I think, is very important. I think is about the governance structure, because if you think for a moment how most pension funds, at least in the US, are run, they're run by boards who ultimately set asset allocation policy and in some cases make decisions. Now, I think the trend over the last few years has been to delegate some of those decisions to funds like the one Andrew has, which has a good investment team that is deep enough and can implement decisions. But until not that long ago, that was not possible. So if a pension fund doesn't have the structure, doesn't have like a category, for example, like an opportunistic bucket or a means of moving fast to take advantage of these opportunities, then that could be a hindrance and it might not move forward. I think the last sort of tactical or opportunistic area that come up here as a result of coronavirus has been on the private debt side. Even with something known in the US as TALF, the Term Asset Loan Fund, which is essentially financing by the government to buy certain fixed income instruments. And so from that perspective, again, if you did not move fast, when that announcement came, within a few months, that opportunity went away, essentially, in terms of the returns that you could have locked in if you were one of the first movers. So if you don't have that structure in place to implement that right away, if you didn't think of that in advance, by the time you saw the opportunity, it may be too late already once you have to go through all the hurdles to implement that.
Gosh, you did such a great job answering that, Leandro. I think you even used the example that I always use, which is high yield bonds in 2008. I think that the list of people that have tried to be tactical with switching back and forth between asset classes is littered with failures. I used the example of me thinking rates were going to decline since 2006. There's a whole history of me being wrong, and I say that not to be funny, but to remind myself that despite being in the market and having a view, not every view requires you to reposition a portfolio to try to take advantage of it, because what matters is, how big is the opportunity? And in my prior job at Wilshire, we used to track a number of different asset class pairs to see if there was enough of a dislocation to try to take advantage of it. And most things kind of traded within a range that was normal. Periodically, you'd get something that was 3 standard deviations away from its own history. And then, at 2 standard deviations, we'd begin to think, is this likely to reverse? And is it going to reverse quickly enough that we will be able to capture it? And is it efficient enough to trade, right? Some things you just can't trade. So taking that back to the 2008 example, the high yield bond market was completely dislocated. The yield to maturity on US high yield bonds was north of 22%. So if you could have just bought the index and held on to maturity and nobody defaulted, you'd make 22% in fixed income. So we said, all right, obviously there's going to be some defaults. We applied the worst default scenario the US had ever seen, and the return was still 14%, higher than our expected return on stocks. And so we said, okay, that doesn't make sense. So we cut it some more, and we got it to be basically in line with stocks. And we did have a few clients that then tilted into high yield bonds as a result of that. But success depended on what the funding source was. So to Leandro's point, if you took money out of core fixed income and you funded high yield bonds, great. That was a huge win. If you took money out of equities and you put it into high yield bonds, you cost yourself a return, right? So you have to be right on 2 parts of this decision: what you're going to sell and what you're going to buy. And then you have to be right when you flip it back to go back to your target allocation. So all of that is to say, I think big bets in institutional portfolios are problematic. I think they're hard to implement. I think Leandro hit the nail on the head. Governance is a huge issue. Having said all of that, Cliff Asness at AQR talks about sinning a little bit. And I think there are times where the market is just absolutely dislocated because there have been forced sales. And maybe those are the times that it's worth 1% or 2% a tilt. And so I make this distinction, and I think it's important. It's corny, but I think it's important. I don't believe in tactical asset allocation with a capital T. I do believe in tactically with a lowercase t, repositioning a portfolio based on the opportunities that the market gives you. But I do think, and this is a baseball analogy, so I hope it translates. I assume that it will. You have to wait for the fat pitch. You don't swing at every pitch. Sometimes the pitcher has the advantage and it's not worth it.
Great.
That's
Thanks.
great. Fantastic. I think we are almost running out of time, but I think we have maybe 1 or 2 questions more, if you don't mind, guys. But we have been
just kidding.
we went through our discussion regarding private equity, regarding public assets, real estate, and so on. But one of the topics that Leo mentioned was about international investments, regarding, it's one of the tools that pension funds have. 3 years ago, it was a nice to have here in Brazil because, again, the interest rates were 15%, and search international investments, that will deliver at least 50%. It was kind of tough to find, but now our interest rates, it's 2%. So this nice to have become a must have. What were the challenges that you guys faced in the US when, moving abroad? Regarding asset classes, regarding allocation, because in our reality 3 years ago, it was kind of a play of diversification and risk reduction, because you can, play the FX in your favor, and then moving through international assets, which, it's a much broader allocation. We have 300 listed companies in our stock market, and our index is comprised by 65 companies, and we have the MSCI All Country Road with 3,000 companies there. So it's a completely different play. But now we can also make this diversification play, risk reduction, but also enhance returns because, again, the interest rates are pretty low. So for us now it's a must-have, but there is a lot of challenges to move our portfolios from a strong home bias with almost 100% invested in Brazil, moving through international assets. So Leo, I think you can start. I mean, what were the main challenges when you guys faced this same situation? Maybe the same challenge or not, I don't know. And what would you say to our Brazilian investors when they are kind of going abroad?
Sure. It's a great question. Some similarities and some differences in the case of the US versus the Brazilian pension fund, but I think it all starts with education. There is a bias towards what's known and familiar to you, and that's what you have closest to you. So that home bias continues to be even prevalent today. So every now and then, even a trustee or somebody, some client might still say we should invest more and more in the US. So it starts in the case in Brazil with understanding that, okay, the Brazilian market is a small piece of the world market. There's industries, there's sectors, there's exposures we don't really have a lot of in our country that we can get overseas. So it's a way to diversify. Countries might be going through recessions. Others will be going through a growth phase. If we invest in many countries around the world, we benefit by mixing all that, and unless the world is fully correlated, we'll have some advantages in doing so. So that's the first one, is education. A second challenge is implementation. And so finding a good partner who's going to do it. If I don't know, and I'm humble to realize that, then who can help me? In the States, that's why, consultants play an important role, and they staff themselves with, resources to go and try to find every possible asset manager and then distinguish who they think is going to be better or worse. I think, again, there is a space to both passive, at least to get some exposure, some beta, but I think there's so much potential there to still go active and try to do better than passive. So I think that's the second challenge. And then the third one, and is one to be very mindful, is currencies. As you invest overseas, you're going to have to change your reais into dollars or euros or something else. And then when you're bringing that back, you translate it again into reais. So you can have gains or losses on that exchange. In the case of equities, typically the currency has not been more than 20 to 50% of the return stream. When you're talking about fixed income, investing in fixed income overseas, the currency movement can outweigh any return on the fixed income space. So I think a rule of thumb is once you get to maybe 30% of your portfolio exposed in currencies other than your own, you need to start to pay a lot of attention to that. I think early on, when you have a small exposure, it's probably a beneficial. It's again another different source of return for you. In the case of Brazil, with maybe half of 1% invested overseas, I don't think you need to worry about it. I think you see that as a benefit of diversification. I understand there's limits of maybe 10 or 20%, so I would move gradually to try to fill those buckets. If I see what's happened in other countries in Latin America, whether it's Chile, Colombia, Peru, Mexico, they've all had limits that were very tight, as in Brazil today, but they've all increased those. And in some cases, I think they can be now easily into the 50 or 80% invested overseas. And those are much smaller economies even than Brazil. And so I think it makes sense. The difference is the US is, half of the world's market cap. So, we have to do a lot less, but I think countries that comprise a much smaller portion of the global capital markets have to do more. So I think in the next few years, you're going to see movements from 0.5 closer and pushing those targets. And then I guess you'll have to go into your legislation to try to provide more flexibility to try to generate the returns.
Great. Thank you. Thank you very much, Leo.
If I can just ask another question. There are two questions from clients here, but I'll merge them into one, and I'll direct it to Andrew because they're pretty much about the same topic, which is portfolio diversification, which goes in line with Guilherme's question just now regarding international assets. But thinking in a broader term, as Leandro mentioned, Brazilian market is very restricted. We have very few companies listed. It's a very concentrated market in terms of sectors, right, for the equity market. So it's very concentrated to commodities and consumer related companies, and we don't have a lot of technology companies, we don't have a lot of other things, but also the questions here are very particular to the institutional and pension fund segments in Brazil, which is very slow moving. You know, as you mentioned, the boards are very strict decision making process, and they're kind of asking about guidelines towards the diversification of the portfolio, in terms of what you guys have been doing throughout the years in the States for the pension funds. So, you know, thinking of our particular market, very slow moving, very, you know, US 10, 15 years ago, what would be a few advices that you would give for the pension funds here in Brazil regarding the portfolio diversification? We also have a legislation that has been developing a lot throughout the past few years in terms of how big you can go in certain positions. So it went from, you know, 3% in international assets to 10%, and there are discussions to increase that. In real estate, it went from 8% to 20% in the past 2-3 years. So we've been seeing the developments towards that. Andrew, thinking about that, you know, in a very broader perspective type of thing, what would be some advices that you'd give in terms of the diversifications of the portfolios, thinking that, you know, they have current to none exposure to alternative assets, private assets, very little to real estate? What would be some advices? And I think we can start to closing remarks with that, but that would be like the summary of those two questions.
So I'm very much a process-driven investor, and the people at my new job are realizing that as I begin to interact with them. And so the way that I would think about this is sort of informed by that approach. The first step would be, how much diversification can you get within local markets that still help you meet your goal? I mean, Leandro just spent some time talking about currency and the effect on portfolios, and that's many times it's something you just sort of ignore. Sometimes it's significant, and you know, you're getting hit with the sledgehammer. You know, currencies in the long run have no expected return to them, but they add volatility. So they're also not correlated. A little bit of currency exposure is diversifying. A lot of foreign currency exposure is a brand new risk, right? So step one would be, what can you get in the local markets to me? Step two is, what's permitted by legislation outside of the local markets, and how much is appropriate for a particular fund, right? And the answer is not going to be universal. I can't say it's, you know, 20% or anything like that. And then I think there's engaging with the pension regulators. And I was not working with the state of California, but Wilshire was the general consultant for CalPERS for 35 years. So we had all the records. And there was a moment in the 80s where, as an organization, they had to engage with the state legislature to allow additional international equity exposure because it was the right thing for the fund. So I think, you know, do what's easy first, diversify as much as you can in local markets. Do what you can with what's permitted next. And I think that's where it gets a little more engaged with the investment committee and the internal governance. And then once you've done all that you can do there, then it's time to fully engage with the regulators. I don't know if that's comment.
I don't know. No, it was very good. I was just going to comment how important the internal governance work is in the pension funds in general. I think now with your current position, you see that and you feel it more than ever. But I think that's some of the main challenges that the investment teams in Brazil with the pension funds have seen, you know, there's a lot of internal work to be done in terms to restructure the whole investment process and be able to actually diversify the portfolios, right? So that's very good. Thank you. I don't know if Leandro would like to add anything as well.
Yeah, my last comment, trying to wrap this up. You know, I think the topic as we started was investing in a world of low rates of return or declining rates, etc. So if I think back, you know, 20, 30 years ago, at least at Meketa, the decision to maybe put more capital into equity, whether that's private equity or public equity instead of bonds, was not driven because we had a tremendous view of interest rates or, you know, are not going to generate the returns we need into the future. I think it was because we realized that when you have a pension fund, you know, you're promising the participants a dignified retirement, not just a fixed paycheck. And so that means that over multiple decades, it needs to cover rising standards of living. And I think philosophically investing in a bond, you know, it's not going to do that. And so equities is what kind of growth with it. And I think that's one reason why, you know, I think taking a 20, 30-year view can help you frame decisions differently than if you're trying to do it quarter over quarter. So I think in today's environment, again, it's not trying to predict where interest rates are going to be in the next 3 months or 3 years, but trying to figure out, okay, where is the next generation want to go and how are we going to get to that point? And again, I think the answers continue to be that I think pension funds will have to invest a substantial portion of their assets in equities to meet their goals.
Okay, excellent. Thank you, Leo. We are really running out of time here. I think you guys, of course, did a pretty good job. So again, it's such an honor to have both of you guys here in our panel. So thank you very much. If you guys would like to have any final remarks, so please feel free to comment anything. Otherwise, we will finish our session.
I
No?
think I've said all that I can say.
Same
Okay.
here.
Okay,
But
guys. So
thank you for the invitation. It was a pleasure to be here to answer questions from you and the audience and to share, you know, whatever little we know here. I hope it is of use to all of you. If anybody has additional questions, I think they can get in touch with you, Guy, and
Okay.
you can provide our contact information, and you know, we'll try to address any additional questions that we did not have time in this session.
Okay, that's great. So thank you again, Leo and Andrew. Thank you very much. Again, it was such an honor. Thank you for the attendees. Thank you very much. Hope you guys enjoyed. Thank you very much. We keep in touch. Bye-bye.
Thanks, everyone.
Bye.
Bye.